Barrick Mining is going ahead with plans to spin off its North American gold assets into a separate unit. The world's second biggest gold producer plans to include interests in Nevada and the Dominican Republic in the spinoff, with assets worth as much as $62 billion. Let's get more on what this means for the broader mining sector with Beichen Lin, Senior Investment Strategist and Head of Canadian Strategy with Russell Investments. It's good to have you join us. Thanks so much.
Thanks for inviting me, Lindsay. It's a pleasure to be here.
Yeah, I mean, let's start with this announcement of the spinoff from Barrick Mining. I wonder, what does that tell you, if anything, about the broader industry?
I think when you look at the metals and mining industry, you really have to understand the macro environment that we're in. So if you think about what happened last year in the metals and mining industry, we saw basically the market cap of a lot of those companies in that sector actually double over the past 12 months. And a large part of that was driven by gold prices. We've seen a significant surge in gold prices over the past 12 months. Now, granted, that did take a little bit of a breather these past few days, but we did see that really strong surge in gold prices over the past 12 months, driven in part by investors asking some more questions around heightened geopolitical tensions, as well as central bank buying activity. So when you have an environment where you're seeing commodity prices become more elevated, I think what's likely to happen is that's going to incentivize some companies to really take a close look at their operations and think about what other types of strategic moves they might want to do. And the other thing to keep in mind is that in Canada, we've seen interest rates come down really aggressively. The Bank of Canada was the most aggressive central bank out of the G7 nations in terms of its rate cutting path. It cut interest rates from a peak of around 5% all the way down to 2.25%. And so because we have a lower interest rate environment, that's prompting more evaluations of spinoffs, of divestitures, of potential M&A activity. And so I think going forward, you're likely to see more activity in this space.
But you say that there's other sectors that you would rather focus on than precious metals, than gold and silver?
So our active managers are constantly evaluating the opportunity set, and within our portfolios, we generally have a very modest underweight to the metals and mining sector. And over the long term, we do think that the metals and mining sector has some tailwinds behind it. If we think about base metals, for example, like copper, as part of the energy transition, and as we move to continue to more electric vehicle adoption throughout the world, that's likely to be a tailwind for base metals. And also in terms of critical minerals, for example, as we see worlds move to a more industrialized and more national security focus, there could be a long-term tailwind there. But in the short term, we've just seen price momentum run up so significantly. And so our active managers see better value in other parts of the Canadian market, for example, in the industrials part, in the financial sector, and also in the utility sector.
Got it. Okay, so let's move on because, of course, we're in the middle of earnings season. We've got a slew of earnings reports coming out today from BCE, Canada Goose. When it comes to what you're seeing so far, particularly with Canadian companies, what's your kind of consensus on how this earnings season's going?
So I think the most important thing that investors need to remember is that the Canadian economy looks very different from the Canadian market. So for example, the financial sector in Canada, it's less than 10% of the Canadian economy, but it represents roughly 30% of the Canadian stock market. And so that's one of the reasons why we've seen over the past 12 months, even though the Canadian economy itself has been under pressure and Canadian GDP might have actually contracted in the fourth quarter, the financial markets, when you look at the TSX actually outperformed the S&P 500 in the US last year. And part of that is when you think about the composition of the Canadian stock market, it's important to remember that a lot of these companies in Canada, they actually derive a significant chunk of their revenue from outside of Canada. As we look ahead to the rest of this year, our baseline expectation is that Canada's economy might continue to remain under pressure, but we expect that the US economy is going to shift from pure resilience towards a potential reacceleration. And into that type of environment, even where we have a Canada-specific slowdown, Canadian companies can still potentially hold up.
There are some other things you're watching for later this month, though. Bank earnings are coming out later this month. What exactly are you going to be watching for when that happens?
Yeah, so bank earnings are an important barometer for Canada just because the banks make up such a large part of our stock market here in Canada. And specifically within those bank earnings, it's going to be important to look at credit loss provisions as well as bank charge-offs because those are going to be important data points about the health of the consumer. Now, one of the trends that we've seen over the past few quarters is that banks have been tightening their non-price lending conditions. And what that means is the non-price component is everything related to, for example, minimum credit scores or the amount of down payment you might need for certain types of loans. And when banks are tightening these credit standards, it means that the result is likely to be a scenario where their loan books improve in terms of credit quality. And that's something that allowed them in previous quarters to be able to better weather this economic slowdown that we've seen in Canada. The other thing we're keeping a close eye on in terms of financial sector earnings is going to be the bank's capital adequacy. So over the past few quarters, we've generally seen a trend where the large Canadian banks in Canada are very well capitalized, maintaining capital ratios that are better than the OSFI mandated minimum. And that could help these Canadian banks better weather a potential economic slowdown.
Got it. We've also got a jobs report coming out on Friday, so tomorrow for Canada. Anything you're expecting there?
So the consensus is expecting flat-ish jobs growth for tomorrow. I think the Canadian labor market continues to be under pressure. If you look at the business surveys, a lot of businesses say that until we get more clarity on the Canada-US-Mexico agreement negotiations, they're going to be reluctant to conduct large-scale hiring. So tomorrow, I think it's going to be important to look not only at the headline number to see where it comes in at, but also really get a better understanding of the composition of job creation as well. Even if we were to get, for example, a better than expected job creation number, if that job creation was similar to where it was in November, where it was driven by non-cyclical sectors, where it was driven by defensive sectors, where it was driven by part-time employment instead of full-time employment, then that would paint a more subdued picture of the labor market compared to if we had a jobs report that was driven primarily by cyclical, full-time, and core age hiring. So understanding the decomposition of the labor market trend is going to be key. And at the end of the day, when we think about where the Canadian labor market is, economists generally estimate that the long-term natural unemployment rate is around 6%. But right now, the unemployment rate is closer to 7%. And when you look at Canada's actual GDP versus potential, we're still likely in what we call a negative output gap, meaning our economy is running under long-term potential. So the Bank of Canada has recently been on hold with its interest rates, but I do think that given the ongoing fragility in Canadian labor markets and given the ongoing fragility in the economy, there is a good chance that we could actually see more rate cuts to come in Canada this year. And that's one of the reasons why we see good value in Canadian government bonds.
All right, we will have to leave it there. So much to digest. Beichen Lin, Senior Investment Strategist and Head of Canadian Strategy at Russell Investments. Appreciate you joining us today. Thank you.